Welcome to the Mortgage Rate Weekly Market Update for the week of April 16th, 2018. Hello, I'm John Thomas with Primary Residential Mortgage here to give you an update. Well, last week was not kind of mortgage rates. They did move higher. Take a look at the bond chart on the screen. You can see mortgage bonds broke beneath that floor of support that they had finally rallied above after a couple months. So it was short-lived, broke beneath that, sold off all week, ended the day on Friday right at the floor of support, but not good news there. It was not a rally off the floor of support. It was more like a pause or a stop after the sell-off. So we don't have any technicals to support a bounce higher. So with that in mind, we're going to recommend locking your mortgage rate. Take advantage of whatever you got. The technicals are not supporting a rally here, so we'll have to see what happens. Hopefully, we can see the bond market recover, rally off support, but more than likely it's going to break through that support, keep moving lower. That would move mortgage interest rates higher. So go ahead and lock in whatever rate you got as we see mortgage rates in the short term moving higher. If we dig into the economic news, we had the jobs report from March 2017 came out, and it was a stinker. It only showed 103,000 jobs created for March, which was much lower than 175,000 expected. Now, February's jobs report was actually revised higher to 326,000 from 313,000, but January was revised lower from to 176 from 239,000. So the jobs reports, they do get revised as time goes on to get better data. So a little mixed bag of reports there. But the unemployment rate remained the same at 4.1%. Now here's some good statistics though. Even though that mixed bag on the jobs report, the average new jobs created in the first 3 months of the year for 2018 was 202,000 jobs created. This is up from the first quarter of 2017, which was only 177,000 jobs created. So even though March wasn't great, the first quarter average is ahead of last year, so we're still doing good. We did see wage growth, inflation, wage growth ticked up from 2.6% to 2.7%. So we were seeing higher averagely earnings. So that's good for the job market, but that's bad for mortgage bonds. That's one of the reasons the bonds have not been doing as good lately. Now, inflation did remain a little bit tame with the Consumer Price Index, the CPI for March 2018. It fell 0.1%, which is below the expectations of a 0.1% gain. Now, the drop came from lower gas prices as we saw the first decline in 10 months at the pump. Now, inflation at the wholesale level was a bit higher with the Producer Price Index, the PPI for March 2018, rising 0.3%. But if we look at the Consumer Price Index, the CPI, it's sitting right about the 2% mark, which is the Fed's target rate. So with it at the target rate, the Fed should not keep raising rates because if they do, that could cause a slowdown in the economy. So we'll see what happens as this information is suggested by the Feds. Now, in their meeting in March, they showed they do expect inflation to continue to rise this year. Inflation hurts the value of fixed investments like bonds. So if inflation continues to rise, you're going to see mortgage bonds continue to sell off. That'll move mortgage interest rates higher throughout the year. So another reason we're recommending locking. It's another reason to get out there and purchase your home. Then we saw weak initial jobs claims come out on Thursday. Claims dropped 9,000 to 233,000 claims for the week. That's well below the 300,000 mark, which is the threshold between a good labor market and a bad labor market. So jobless claims and unemployment remain low, and that bodes very well for the labor market. So we have a strong labor market as seen in all the reports we're getting. So that's good news there for the economy. Now in housing news, CoreLogic's home price index for February was released. It shows home prices are up 6.7% from February of a year ago, and they were up 1% from January of this year. So CoreLogic predicting home prices to move up 4.7% in 2018 from February of 2018 to February 2019. And again, the big driver of home prices is the limited inventory of homes for sale. We do not see any relief in sight for that. So that's going to keep home prices, upward price pressure, moving them up. So again, if you're looking to buy sooner rather than later. Two reasons: higher rates, higher home prices. Then we saw CoreLogic release their loan performance insights for January 2018. It showed that mortgage loans 30 days or more past due decreased from 5.3 to 4.9%. Seriously delinquent loans, which are 90 days or more past due, remain stable at 2.1% of all mortgage loans. And seriously delinquent homes in foreclosure remain stable at 0.6% of all mortgage loans. So very good report on the stability of the mortgages that are out there in the market. So we don't see any reason to think homes are going to start being lost and the values to go down, because people are getting equity. Delinquent mortgages are going down, so that's good news for a strong housing market. Now in the local news, we got a first-time homebuyer seminar this Wednesday, April 18th from 6 to 8 p.m. in Wilmington, Delaware at Independence Mall. It's at the eXp Realty office, which is Suite 88. And then we're in Newark on this Saturday, April 21st from 10 a.m. to noon at the Christiana Hilton Hotel. You can register for either one of those events by giving us a call in the office at 302-703-0727 or online, www.delawarehomebuyerSeminar.com. Look forward to talking to you guys next week.